Hello and welcome to Forex.Academy, your #1 website for Forex and crypto education and analysis. In today's edition, we're going to be discussing Trading Algorithms Part 6, the stages of a trading algorithm. In this video, we will discover the different parts needed for the complete trading system. One of the most common systems involves the crossover of two moving averages, a short and a long-term SMA. Let's do a system based on this idea. Creating a trading algorithm involves at least two stages, the entry logic and the trade management logic, and the position sizing logic. The entry logic. The entry logic sets the rules for entries. This logic can be subdivided into two sections, the entry signal and the filter or trade setup. The entry signal. An entry signal is a moment in time when something happens in the asset. Entries can be MA crossovers, level breakouts, bullish or bearish candlestick formations, and so forth. The filter. A filter is a condition imposed for the entry signal to be valid. For instance, you can allow a MA crossover to the long side only if that main trend is up. Then, you can programmatically define the primary trend, and this is the filter. For instance, we could describe an upward direction when the price is higher than the +1 SD line of the Bollinger Band, in which we set the bands to 1 SD instead of the standard 2 SD. We could also say that the upward trend is the price above the 200 period MA, or when there are higher highs and higher lows. A downtrend can then be defined using the opposite logic. On mean reverting assets, an interesting filter might be overbought, oversold indicators such as RSI, %R, or stochastics curving against the current move, allowing then the use of candlestick reversal signals. We can also add a filter that excludes trades whose projected reward-risk ratio is below 1. As a caveat, the higher the number of conditions, the higher the probability of over-optimizing it. The best designs are those with fewer parameters. Also, the higher number of filters, the less the system will trade. Thus, more filters doesn't improve a raw signal. When building your trading system, a sound methodology is to start with raw entry signals and a time stop at a determined number of bars. If the entry has an edge, it will be proved by higher than 50% profitable signals after 5 to 10 bars. The trade management logic. Trade management logic takes care of open trades. It is constituted of at least a stop-loss logic and a take-profit logic. It may include other decision steps such as break-even logic and trail stops. The stop-loss. We have already published several articles on stop-losses. There are several ways to set a stop-loss level. We can do it by using a multiple of the average true range of the asset, using the last swing low or high in the case of the short trade. We can also statistically optimize the distance using John Sweeney's maximum inverse excursion, or the MAE concept. Trail stops are also a recurrent idea in trading, although the developer should test them and assess if they really improve the results. The same is valid for the break-even logic. Both concepts seem logical and mind-relieving, but I have yet to find the utility to improve a trading system. In some trading systems, a time stop can be handy. A time stop closes if the trade is not profitable after a certain period or a specific number of bars. The take profit. Take profit logic can also be varied from dollar-based stops to stops based on key levels, supports and resistance or pivots. A take profit condition may be set too. When a signal opposite to the current trade happens, such as a MA crossover against the trade, the price below the -1 SD Bollinger line on longs or over +1 SD line on short positions. Take profit code can be added for scaling out of the trade, letting a % of the original position open to ride the wave, and improvements when your trade is right. Position sizing logic. The position size logic is a final step that involves setting up the right trade for the right trader's objectives. This step should be used in real-time trading, not during the definition, optimization, and evaluation of a new trading system. During the definition step, a trading system must be used with one trade unit, and its results normalized to its risk, so instead of dollar profits, it should produce a stream of multiples of R, a standard $1 risk. Position sizing logic is to maximize the returns of a system and limiting the max drawdown to the levels desired by the trader. We will further develop these concepts in the coming videos, with specific algorithms demonstrating how to create them properly. If you enjoyed the video, then please like and subscribe, and leave a comment down below about anything you would like us to discuss in future, or if you have any questions about this particular video. Have a great day.